Hello there, I'm Charlie Fuchs, on the line with Jonathan Tryercroft of Lonsin Global Fund and Advicorp to discuss the nationwide HPI data release earlier today. Jonathan, welcome. House prices recorded their 14th successive monthly increase in June, rising by 1%. We have seen a steady HPI incline over the past year or so. Do you forecast this will continue to be the case?
Well, I think the general HPI for the whole of the UK is strongly influenced by regional data. So, for example, house prices in the UK overall are recorded as rising, but there may be places, parts of the UK, where prices are stagnant or even still falling from historically depressed levels as a result of the recession. So I think we have to look at what's happening in the economy overall, and it's been reported as well this week that the economic recovery in the UK is still being revised upwards, with growth reports forecast to be as high as 3% this year. And some of that is coming from manufacturing as well, which is a very good sign. However, it's also the case that across the UK, real wages are still lagging. And I think a combination of a strong currency and possibly rising interest rates are going to squeeze wage demand. So over the UK as a whole, I don't see a particularly strong impetus behind demand for housing in the next 2 to 3 years.
Despite another positive month for HPI in the UK, Nationwide's chief economist Robert Gardner suggested today that mounting expectations that interest rates may rise earlier than previously anticipated may act to dampen housing market activity in the months ahead. Do you see this as a possibility?
It certainly is, in terms of just looking at the basics of the economics. I mean, historically, record low interest rates for an unprecedented period of time, 5 years or more, has definitely fueled a boom in property investments in parts of the UK. And as the cost of borrowing rises, this has to be considered as a downward effect on demand. So I understand where Nationwide's chief economist is coming from. However, the price of a residential asset will be influenced by demand and supply, and the demand side is made up of a very wide range of interested parties. For example, in London, we have seen a surge in demand from overseas buyers, which was initially driven by a capital flight from less open political zones, including, I might add, the Eurozone during the Euro crisis. This fed into a secondary wave of demand as estate agents saw a marketing opportunity to a very willing audience. And so they would go to overseas buyers, say, for example, in the Far East, and present the opportunity to invest in London property, but only in London. The physical result of this can be seen all over London, but particularly along the banks of the Thames, where just about every plot of development land now has a high-rise, high-end block of apartments built on it. So this recent phase of demand then led on to an influence on more what I would term native buyers, people actually resident in the UK, who feel the positive effects of this. And that in turn, I think, has led to what we've been seeing for a while now, but it's currently going on as well, is an outward ripple effect from, say, Zone 1 of London, which is spreading to what was traditionally called, I suppose, the commuter belt. So you're certainly seeing buoyancy in property prices in the outlying areas of London and beyond in the southeast of England. But the point I'm trying to make is that whatever happens to the wider UK economy is only partly reflected in the demand dynamics. These other effects have been termed by economists to be external shocks, which have had a very large effect on demand. And whilst these shocks may be sporadic, they are of course unpredictable. So who can say where the next big wave of demand from overseas could come from? It may be many, many years before we see it again.
Gardner also noted that the price of a typical property in London reached the 400,000 mark for the first time, with prices in the capital now around 30% above their 2007 highs and more than twice the level in the rest of the UK. How do you predict this record peak in the capital will affect other regions in the UK and their annual price gain performance?
Well, I think as I mentioned just now, I think that we're already seeing a ripple effect, a knock-on effect to outlying regions. And this should continue for some time with a backdrop of growth in the UK economy as well. So, generally speaking, it's a positive, but we must bear in mind that the supply side will have a very large effect on this, an equal effect, of course, as well. And it's been in the press from the politicians speaking all the time from both Conservative and Labour that there has been a serious backlog of building of new housing in the UK, and this has gone on for many years. So what we definitely need to see is an increase in supply, which of course is going to help dampen price rises. But I suppose I would ask the question that if you were looking to a 2015 general election and had influence over the supply side of the housing market, would you really want to boost supply ahead of the general election, given that would normally put a slightly negative effect on house prices?
Thank you, Jonathan, for your comments. That's all we've time for, but do continue to click on the Dukascopy site for more insights into your trading week. Goodbye.